My name is Jared Getenga. I'm CEO of CIS Kenya. Some of you would wonder who CIS is. We are a member-based association that champions the development of credit information sharing in Kenya. But our mandate goes further than just credit information to other forms of infrastructure that benefit consumers and which support credit risk management in financial institutions. And therefore, our partnership with Sicr Assessment is intended to further understanding of risk issues, particularly in credit. And today's conversation is motivated by the fact that IFRS does introduce issues that need to be discussed, particularly in the context of COVID-19. As you will all know, COVID-19 really started as a health pandemic, but its tentacles have extended further into the financial system, and it poses a great threat to credit risk, particularly because loans have had to be restructured and other efforts have had to be made in order to recognize the risks associated with the loan repayment. As opposed to IS 39, which had a different approach to recognizing losses, the IFRS 9 has got more demands and greater impact when risks are recognized. And therefore, in the context of credit risk, we would like to share some insights, and we are very happy to partner with Care Risk Solutions in this discussion. And therefore, without much ado, I'd like to welcome Vishu. Vishu as Gurav, we call him Vishu in short. Vishu is from Care Risk Solutions, and he's the business head for Africa and Middle East. He will introduce his team and proceed with the seminar organization and deliberations. Thank you, and over to you, Vishu.
Thank you so much, Mr. Jared. Now, let me just quickly introduce the team from our sides, and then I'll actually cover first two slides in terms of who we are, and then pass it on to the experts, right? So my name is Vishu, as Mr. Jared mentioned. We have Mr. Subbu, who is our global business and product head. Then we have Mr. Arun Ramnath, who is our director of products and pre-sales. IFRS is something which is very close to him. He has been, instrumental in building this entire practice for Care as a group. He will be actually, one of the prime speakers today. Then, I have Visa also. So Visa Lakshi is our pillar head towards IFRS, platform. Again, chartered accountant by herself, and a lot of experience in international markets in consulting as well as implementing IFRS compliance. Now let me actually start with the presentation quickly, right? So today we will talk about the IFRS reporting compliance for banks and financial institutions, and we have quite interesting session which will be coming out today. Now just to quickly take you through in terms of who we are, right? So we belong to a group called Care Ratings Group. Care Ratings is one of the premier and largest credit rating agency in India. We are in existence for almost 23 years. Credit has been part of our DNA. Credit rating, credit consulting, valuations, then analyzing various organizations in terms of stress, then economy outlooks, various sectors outlooks, and all that, right? That is something which we do as a group day to day. Then when it comes to overall our rating experience, we have actually rated more than 76 1,000 overall assignments, across the globe, which spread, right from India to overall, Asia, to Russia, to Japan, to Southeast Asia, as well as, European Union. We are present in Mauritius, which is our, wing towards Care Ratings Africa. Then we are actually, expanding ourselves to some of the other continents, like European Union, then, even Malaysia, Japan, and all that. Then when it comes to, overall debt, which we have rated and all that, right, that comes to around $1.8 trillion, right? You can see that, it's written out here in Indian currency, but it comes out to be, $1.8 trillion. So we have a quite vast experience when it comes to, credit rating, external credit rating, and all that. Now, let's move to the next slide and understand, what exactly, Care Risk Solutions does. Now, Care Risk Solutions is a highly specialized niche provider for risk and compliance consulting, as well as actually, various software platforms. So what do we do is, across all the risk aspects, right from business risk to, IT risk, which complied, from Chief Risk Officer's portfolio to Chief Financial Officer's portfolio to even Chief Technology Officer's portfolio. We actually, are a specialized providers towards all these, elements. Right from, very, very strong consulting wing, where we do a lot of risk consulting towards credit, towards market risk, toward, even compliance, like IFRS compliance, which is, quite critical these days, and we do end-to-end implementations also. We digitize, automate, the entire risk processes, entire compliance processes for the banks. All of our customers, which are actually more than 80, which are spread across 10 different geographies, are referenceable customers. And that means that, we are complied with more than 10 geographies and markets when it comes to their central bank regulations. Of course, we are, ISO certified. We have our own thought process when it comes to innovation, research and development. So we have a dedicated, element towards, innovation, where we actually, constantly work on, various compliances, regulatory compliances across the globe. This IFRS platform or IFRS, practice which we have has been recognized by various, conferences, various risk, assessment agencies. So we have actually, presented two of the those accolades here, right? Our modeling has been, rewarded as best in class, ECL IFRS modeling in 2019, and consecutively in 2020, we have been actually, awarded for our innovation towards IFRS. Some of the consulting and implementations which we have done in East African regions also has allowed banks to win, reputed awards towards global financial compliance and all that, right? So our philosophy is to keep, the processes, the solutions very open, dynamic, configurable. Now, without taking much of your time, I would like to hand it over to Mr. Arun and Visa to take it forward towards the IFRS presentation.
Hello, everybody. This is Arun Ramnath, and over the next hour and a half, I would want to walk you through, along with Visa, my colleague Visa, on the various aspects of IFRS 9. For bandwidth reasons, I'm just So given that we have a very short time and a very vast topic to be covered, I hope I'm able to do justice to time and cover at least the major aspects that come to my mind when it comes to an holistic IFRS compliance perspective. So firstly, the most important thing that comes to my mind at this point in time, especially when the impact of COVID is felt, is that most of the banks are going to face this in terms of the impairments. So if we were to look at the bank's balance sheet and try and analyze the areas relating to impairment that come to my mind are possibly impairment with regard to property, plant and equipment, which is commonly referred to as PPE. So one is the PPE related impairments, and the second and the most relevant to our discussion today is the impairment of financial assets. So this is typically the recoverability of financial assets recognized at amortized cost. Now that I have mentioned or made a reference to financial assets and probably its classification or recognition, I am sure most of you would be aware of the two-stage methodology in terms of classifying the financial instruments. One is the business model test and the other is the contractual cash flow test. And we broadly classify them into three categories, which is the FVTPL, which is the financial, which is the fair value through profit and loss. The other could be fair value through other comprehensive income. And the last category that we have is the amortized cost. I hope most of us present here would do good to appreciate that there is a whole lot that goes into the computation of ECL. And there are these certain components of computation like probability of default and exposure at default that would need to be revisited during these unprecedented times of COVID-19. Mainly because most of the assumptions would have definitely changed. So maybe the PD would have increased, or the definition of default itself would have undergone a change. Maybe because the regulator would have issued guidelines around the change of definition of default, or possibly the exposure at default would also have increased had the customer reached the point of default at this given point in time. So we will be discussing all these components and all other components related to IFRS 9 ECL computation in our forthcoming slides. But what I'm trying to highlight here is it's not just the IFRS 9 that needs to be looked at in isolation. We are aware that IFRS 7 relates to various disclosures related to the IFRS 9 ECL computations. We can already appreciate that IFRS 9 per se is not standalone. And I'll tell you why when we look at the interlinkages. So eventually, when we're looking at the set of chart of accounts that are rolled out of any system, what we're essentially seeing, for it to depict a true and fair view, it needs to be in compliance with not just IFRS 9, but all the relevant and applicable financial reporting standards. So another example of interlinkage that comes to my mind is the IFRS 9 requires the banks to assess whether there has been a significant increase in credit risk for all its financial assets, including these financial assets with maturity of 12 months or less. And the reason that I'm specifically referring to this case is that even though the 12-month ECL is the same as lifetime ECL for these financial assets, the distinction is still required to be captured mainly for, say, disclosure reasons that IFRS 7 requires. Since IFRS 7 has mandated entities to disclose separately financial instruments for which loss allowance is equal to 12 months ECL or the lifetime ECL. So now we are already started seeing that there are a lot of interlinkages. Now, when it comes to IFRS 13 fair valuation, we would be aware that there are three levels of valuation, namely the L1, L2, and L3. That is followed based on the availability of observable inputs. So if we were to consider the valuation methodology, say under the L3, one needs to be aware of the situation that the methodologies could have been impacted because of the current situation, which could essentially mean that these methodologies needs to be revisited to ensure that there is accurate fair valuation. So for example, if we were to consider the discounted cash flow model, the assumption based on which the cash flows are arrived at would have undergone some change. And as a result of this COVID pandemic, not only these cash flows, but also the weighted average cost of capital could have possibly undergone a change. And why would the WACC have undergone a change? Maybe because the risk rating would have got impacted as a result of discount, as a result of which the discount rates are also getting impacted. So if you see that we have to have a holistic view when it comes to any computations that are there under the IFRS perspective. I hope I'm able to bring out these interlinkages and provide a holistic view to you. Now, there could be other areas related to IFRS accounting or auditing that can be discussed, like say IFRS 16. There could be assessment of maybe the going concern assumption itself, or maybe events which could be adjusting or non-adjusting type of subsequent events. There may be even, let's say, discussions around impact of this COVID with regard to employee benefits computation and its related actuarial valuations. So the discussion can go on, and this subject is an ocean in itself. But we would like to confine the discussion today to only the IFRS 9 related areas. So if you were to move to the next slide, what we're essentially seeing here is IFRS 9 vis-a-vis the erstwhile IAS 39. And the most important difference that comes to mind is that the IAS 39 has always been an incurred loss provisioning model, whereas the IFRS 9 is an expected loss provisioning model. So the moment we say expected, we mean that it is forward-looking. And FASB is also of the belief that this forward-looking better matches the anticipated losses. Whereas if we were to look at the incurred loss model, it only considers the historic or the current periods for its provisioning requirement. And it is not a forward-looking measure in any way, which is essentially mandated by IFRS 9 Ecl Computations. So if I were to draw your attention towards the graphs, firstly towards the graph on the left-hand side of your screen. So the economic cycle as depicted by the red curve is a normal economic cycle. But if we were to analyze as to how we are building provisioning reserves under both the regimes, one is the IAS 39 regime and the other is under the IFRS 9 regime. The IAS 39 regime tends to lack tends to kind of lag the economic cycle. So if you see, when we are midway through the downturn in the economic cycle is where we have started creating the provisions. Whereas if we were to look at the IFRS 9 related provisioning, which is indicated by the green curve, we would realize that it tends to kind of lead the economic cycle. So this is what is the pro-cyclicity measure that we are referring to. So it is either moving with the economic cycle or in a sense just leading the economic cycle. Now, if I were to draw your attention to the graph on the right-hand side of your screen, we would see that there is a coronavirus shock or the COVID pandemic shock that you can see over there. And as a result of which, there is a sharp decline in the red curve, which is our economic cycle curve. And this sharp decline essentially necessitates us to have an equally rapid or fast reserve building process, so that it doesn't eat up into the bank's equity. And just 1 second, please. And this highlights the relevance of IFRS 9 from a provisioning perspective. So it is needless to say that COVID-19 as a shock is clearly exposing the banks to unexpected losses. This literally means that the banks would be having not be having existing provisioning in place, right, under the expected credit loss regime. So with this, I would like to take you to the next slide, which would talk about are you able to see this slide? The expected loss 12-month versus the lifetime, which also is to do with the staging. So under IFRS 9, all the loans and advances carry an ECL provision from the first day that the loan is recognized in the books. This provision is based on expected losses for 12 months only. IFRS, however, prescribes that this 12-month provision should be increased to what is known as the lifetime credit loss, as and when there is a significant increase in credit risk from the point of initial recognition. This particular process of increasing the level of provisioning is what is staging. So if an asset is in stage 1 of the model, then the ECL is measured at the 12-month expected credit loss. However, if there is a significant increase in credit risk, so though I'm mentioning this term significant increase in credit risk, I would be discussing this in further detail in the subsequent slide. So when there is a significant increase in credit risk, then the asset is moved to stage 2 or stage 3 of the model, and the ECL is measured at a lifetime ECL. So it majorly depends on whether there has been significant increase or in the credit risk or not. Now this could lead to substantial provisions, especially for loans that are having a longer duration. So with the current sharp downturn in the economy, accompanied by maybe negative forecasts, it is likely to trigger staging for large number of accounts. Further, the bank will also need to update their macroeconomic factors or forecasts, which would be needed to update the downturn scenario. This downturn scenario would essentially look worse than the pre-COVID downturn scenario. Also, the relative weighting, sorry, I got something written on the slide, please. This downturns, so that basically when I'm saying this downturn scenario would essentially look worse than the pre-COVID downturn scenario. Also, the relative weighting of the scenario may need that updating under conditions, and the weightages would also need to be given, keeping in mind these conditions that are ever evolving. So these aspects suggest that the bank should not apply an ECL methodology just mechanically. Now it is important to dwell upon and contemplate whether the existing ECL methodology are still kind of fit for the purpose, as these would kind of been built pre-COVID, right? And corroborated with a very different economic reality to what we are currently facing. So this needs to be actually re-looked into. Further, it may also necessitate that the collective pools that are created earlier would have a different kind of scenario basis which they are created. As the as these characteristics of homogeneity based on which they were created would have also undergone some kind of a significant change in this pandemic situation or the post-COVID situation. Further, there are other relevant factors that need to be discussed, like possibly we would look at things around moratorium or payment holidays. Now, if you were to, why is this so peculiar or important? Because if you were to look at a moratorium or a payment holiday in a pre-COVID situation, it would essentially indicate some kind of a financial difficulty or distress for the borrower. And then we would possibly have moved these exposures to stage 2 or stage 3. But now in the post-COVID scenario, it is no longer the case, because there could be some blanket payment holidays or moratoriums that are announced by the respective central banks or the governments. And these may be availed irrespective of whether there is current financial difficulty or not. So this may mean that there is just a temporary liquidity which they are trying to cross. So in such case, the lifetime credit risk might not have increased at all. So they may as well stay in stage 1. However, if you were to look at this holistically, not all borrowers will be in that category, but some of the borrowers who have availed the moratorium may actually have resulted in some kind of a significant increase in credit risk. Hence, it is a kind of highly inappropriate to say that move all to stage 2 or stage 3, and similarly, it is equally inappropriate to say leave all in stage 1. So this, and why I'm trying to highlight this point is, so this essentially means that any system or automation tool that has been implemented at the bank or probably is going to be implemented at the bank should provide the flexibility in incorporating these changes with regard to maybe the staging criteria or Sicr assessments, which I'm going to refer to in the next slide. Also, another critical aspect that needs to be borne in mind is probably relate to the relief packages that are announced by the government. This could be both with regard to these relief packages that are announced for the banks or for the borrowers of these banks. Now, one important thing that needs to be borne in mind is these relief packages do not affect staging in any way, as staging is based on probability of default and not on the loss given default. Loss given that the default actually happens. So this point needs to be appreciated. We can move to the next slide, wherein I'll speak about the Sicr. So this is a large topic in itself, and it has gained a lot of significance in the post-COVID situation. So just to reiterate what I had stated under the staging, that under IFRS 9, whenever any loans and advances are originated, they would carry an ECL provisioning from the very first day. And this is typically a 12-month expected loss provision. And only if there is a significant increase in credit risk, the loan moves to stage 2 or stage 3. And the bank needs to increase the amount of loan loss provisioning up to a lifetime credit loss, expected credit loss. So now, what is the significant increase in credit risk, and why would it be such a key factor in implementing this IFRS 9 standard? So it is important for each one of us to note that Sicr is nowhere defined in the standard. So it is just a judgment that the banks would require to make when they are implementing this model. And when they are making this judgment, they should bear in mind that the judgment that they are making could significantly impact the amount of impairment losses that they are going to book. So we can either look at, if you were to see, we have classified it into three categories. One is the quantitative indicators, qualitative indicators, and the backstop indicators. So we can either look at PD and as a specified percentage increase in the PD as an estimate of a significant increase in credit risk, or also consider some of the other quantitative indicators. However, if SICR is not only, however, if this SICR, I would say, should not only be confined to quantitative indicators, but we should also look at the qualitative indicators at length, and the backstop indicator, which acts as a last stop in terms of a rebuttable presumption. So one important thing is this assessment on whether this assessment of SICR, can it be done on an individual loan basis? So if you were to look at the retail portfolio, there are so many loans. So it would be highly impractical to do the SICR assessment on a loan by loan basis. So this brings us to the concept of segregating them into individually significant customers and the other set of customers who are not individually significant. So those who are not individually significant, we group them into a pool of collective, which we call as the collective pool, and then perform an impairment process on them. So I think there's somebody needs to mute their mics, please. Yeah. Now, when we're grouping, we need to know that we have to have the grouping based on some similar characteristics, and these similar characteristics that we're referring to are in relation to the credit risk characteristics. And why is it not advisable to group these loans on dissimilar credit risk characteristics? Because by doing that, what we'll end up doing is actually ignoring or masking some of these significant increases in credit risk, and that's in a way going to lead to non-compliance from an IFRS 9 perspective. So before getting into the next list, which is the qualitative indicators, I would say that there are rating models which could also act as inputs, which could be both statistical and non-statistical based models. Under the qualitative indicators, I have currently, there's a list of 16 odd indicators that have been considered. And again, let me be kind of give a disclaimer here, saying that these 16 indicators are not the only list of indicators, or it's not an exhaustive list of indicators. It's just purely suggestive or indicative kind of indicators. So it is truly up to the judgment of the bank on how to incorporate the relevant SICR criteria for both qualitative and quantitative. And it also would bear in mind the fact that how much is the cost and effort that is involved in getting information related to each of these criteria that we're incorporating as part of the SICR checklist. But what essentially we need to bear in mind is any tool needs to provide you that flexibility to be able to incorporate these criteria into the checklist and remove them at any point in time that you may deem it irrelevant. So in an overall SICR assessment, I would say that when we're looking at the holistic analysis, is just not the historical information, but also forward-looking information that needs to be incorporated. So let's say when we say that there are behavioral indicators that we're incorporating into the checklist or SICR model, as you may want to call it. These behavioral models, one needs to bear in mind, is essentially doing an analysis on the past. But what we always want to have is forward-looking indicators. So we need to have a mix of not only the behavioral indicators, but also incorporate some predictive or forward-looking indicators of default. So if I were to give an example, typically we need to look at, let's say, near delinquency kind of situations, whether and see whether there is additional drawdowns that are happening. These are going to act as indicators of significant increase in credit risk. So on that note, I would hand over the floor to my colleague Visa Lakshi to walk you through the subsequent slides. Before she takes over the previous slide, just an indication as to how the IFRS 9 provisions are so relevant, and it gives a better control of all the scenarios for the banks. So thanks everybody, and over to Visa.
Hi, good evening everyone. I think someone has to go on mute. Yeah, thanks. Good evening everyone, and thanks a lot for the opportunity for showcasing our IFRS 9 webinar, for showcasing our solution as well as providing an opportunity to us. Okay, thank you, Arun. So to begin with, what is ECL? So basically, it is the expected credit loss. How to measure this expected credit loss? In a very layman's language, it is nothing but the difference between the contractual cash flow versus the expected the recovery amount which we are planning, which we will be recovering from a particular counterparty. So let's break it down further. So when we say the contractual cash flow versus the expected recovery, that becomes that will be a very actual amount which we will be recovering, which we will be the loss which we will be incurring. When we attach this probable, however, we are measuring this expected credit loss today, right? So what we want to do is we want to attach one more factor to it. What do we call it as probability of default? So that's why this is contractual cash flow compared to the expected recovery, and attaching what is the probability that that particular person might default. And also we want this ECL provision, as I said, today. So that's why we are also getting it to the present value, and that too at effective interest rate. So why effective interest rate and why not original interest rate? The reason being, effective interest rate is the actual yield that we would get from that particular customer. Reason being, effective interest rate is the rate which is measured after ignoring all the transaction fees, facility fees, etc. So that would provide the actual yield. If we break this formula further, if you see here, what it shows, this is nothing but the exposure at default today multiplied by 1 minus economic recovery rate, and this PD at today's time remains constant here. So when we break this formula, EAD into 1 is nothing but our exposure at default. Exposure at default into economy recovery rate, that is nothing but our LGD factor, that is loss given default, and the PD remains as it is. So this is the as such entire structure of this ECL computation parameter. So this is nothing but present value at EIR of product of exposure at default, LGD, as well as PD. Before we move on to what is how this PD, LGD, and EAD are computed, first I would like to take you through what do we mean by each of these parameters. This probability at default is nothing but where we assess the likelihood that the person might default in future. What is the probability that he might default in next 12 months or next 6 months, or even the lifetime of the loan? However, along with consideration of the business cycle and the risk characteristics of the particular individual. That should also be taken into consideration while we are measuring the probability at default. Loss given default, it is nothing but the actual loss that the bank might incur when a borrower defaults on the loan. So it is generally depicted as the total exposure at the time of default. So we have various methodologies using which we can measure this loss given default. So we will discuss at length in the coming slides. And exposure at default. So as the name suggests, that how much exposure of that particular counterparty or the transaction of that counterparty is at default. So basically, when we look into stage 3 accounts, so basically those are totally 100% credit impaired accounts. So in those cases, our exposure at default will nothing be the actual outstanding amount. So that is why there are two types of EAD. One is ex post EAD, that is actual, and one is ex ante EAD, which is predicted. So in case of stage 3 accounts, the actual outstanding or the gross carrying amount will be the exposure at default. However, in case of stage 1 as well as stage 2 accounts, this outstanding amount will have to be predicted. So we will have to take into consideration the prepayment features, the contractual cash flows, and assess the EAD, taking into consideration that the outstanding amount residual maturity might be for next 10 years or 20 years or 5 years maybe. But in case of stage 1 accounts, we will have to ascertain what if, how much he will default in the next 12 months. However, for stage 2, it will be for the lifetime of the loan, basically the entire residual maturity. So this would be the EAD computation practice for normal loans. When it comes to revolving facilities or when we speak about letter of credit or bank guarantee, we will also have to take into consideration the usage given default as well as the credit conversion factor into consideration. So the usage given default or credit conversion factor, that is nothing but when we speak about revolving facilities, over there we have two components. One is a drawn component as well as undrawn component. So there is always a possibility that the undrawn component might be drawn in future and that might also default. So today, when we are providing for that particular counterparty, we will have to take into consideration this undrawn factor as well. So because it is entirely conservative approach as well as forward looking. So we are taking into consideration the entire business cycle and being forward looking. So we are basically today anticipating the loss that would happen in future. So moving ahead. So before, so next is, we have heard this terminologies many a times, so called as point in time PD and through the cycle PD, etc. So what are the basic differences between point in time and through the cycle PD? Point in time is basically assess the likelihood of default over a future period. So that's why we call it always forward looking, because we take into account the macroeconomic factors and how that particular macroeconomic factor, basically the actions of macroeconomic factors affecting the provisions or the likelihood of the payment by a particular counterparty. However, in through the cycle PD, what happens? It does not take into consideration the characteristics of macroeconomic factors. It always remains static and it only consider the risk characteristics of the individual. That is one of the main difference. And second difference is through the cycle PD, we compute only 12-month PD. We do not compute lifetime PD. However, when it comes to IFRS 9, we want 12-month as well as lifetime PD, because for stage 1, we would have to apply 12-month PD. When it comes to stage 2 and stage 3, we want lifetime PD. So what is basically this 12-month and a lifetime PD? So 12-month PD is not the PD for the next 12 months. Instead, it is the entire lifetime PD. Out of that lifetime, this is just a portion of the lifetime, that what would happen in next 12 months, and not the directly we are computing 12-month PD. So that is a thin line difference between interpretation of 12-month PD. Like Arun earlier discussed in the pro-cyclicality slide, that when we are even with the shock and without the shock, the point in time PD follows the business cycle and changes over the time. So whenever there is a downturn happening in the economic cycle, before the downturn happens, the IFRS 9 becomes proactive and provide for. However, when it comes to IAS 39 or through the cycle PD, it is stable and smooth over the business cycle. The graph is stable and smooth over the business cycle, and the provision happens only after the downturn is improving and not before that. So these are the basic differences between these two methodologies. Now let's dwell upon the different modeling approaches. There are actually several approaches which can be used for ECL computations. The standard does not prescribe any of the methodologies. We will have to, the bank as well as the user will have to decide on the methodologies after studying their business model, after studying the portfolio of the bank and the individual characteristics of risk characteristics of their customers. And all these approaches will have to be reviewed at every reporting cycle, and the basis the accounting practices, the best fit methodologies can be adopted for. And most important for ECL computation is the data availability. So we would require historical data in place. The historical data needs to be sanitized properly for a very accurate ECL computation. So moving ahead, so the methodologies when it comes to probability of default. So there are various methodologies like transition matrix model, Markov chain, Weibull model, distance to default approach, etc. So starting with transition matrix model, this is one of the globally accepted best practice model. What do we do in this model? Basically, we draw a transition matrix by taking into account the 1 year reporting period comparison, or half yearly reporting period, or quarterly reporting period comparison. In this transition matrix, as the name suggests, it is only transition matrix. We will not be taking into consideration the accounts which are cured. We will be only taking the accounts which is worse. For example, when we are comparing 1 to 30 days bucket of the current reporting of the one of the reporting cycle with other vis-a-vis other reporting cycle, we will be directly taking into consideration only the worst. That is, we will only be starting comparing the movement from 31 to 60 days bucket only. We will not be taking into consideration 0 days and 1 to 30 days. So this is one of the disadvantage of this model. However, in this model, we can have an average, we will be computing an average PD by taking into large data set into consideration. And we can arrive at 1 year, 2 year, 3 year PD, etc. And for computing the lifetime PD, we can use the scaling factor and as well as macroeconomic factor into consideration and compute the point in time forward looking PD. When it comes to Markov chain model, so or matrix multiplication model, here we will be taking the entire data set into consideration and finally arrive at what do we call it as conditional and unconditional PD, cumulative conditional and unconditional PD. So here we are not ignoring any of the data sets at all. So the accuracy of the model is very high. And also in some matrix multiplication model, we take only the data set which are directly above 90 days, only the accounts which have directly defaulted, and arrive at the cumulative conditional unconditional PD. And when it comes to distance to default approach, so here what we do basically is we take a statistical modeling and arrive at how much is the distance that particular person might default. So this is generally not applied much. However, when it comes to Weibull model, this is a very effective method for determining the default when we have a very small sample size when we have a very small sample size. So if we do not have historical data in place, so huge historical data in place, we can go for these kind of models. So that was about probability of default. Moving ahead to loss given default, various methodologies here when it comes to measuring loss given default. We have workout LGD, market LGD, market-based model, and asset pricing model. So to begin with, workout LGD, that is basically the discounted recovery model. So here, we would require historical recovery data in place to measure the loss given default. So here we will be directly comparing the outstanding against the present value of the recovery to the date of default and assess the LGD. When it comes to market LGD or market-based model, here what we can take into consideration the collateral-based data or the cure rate into consideration and assess LGD. When it comes to asset pricing model, we can price the asset basis the market value and arrive at LGD. So these are the various methodologies. However, to measure LGD, what do we require is we would require collateral data. If we have collateral data in place, we can link it to the transactions and we can arrive at LGD. We need proper historical data, historical recovery data in place. And also the dates, also the data related to the date of default as well. Next, about exposure at default. When it comes to exposure at default, as I stated earlier, so in case of stage 3 accounts, it is very straightforward. The outstanding amount will be the exposure at default. However, when it comes to stage 1 and stage 2, we will be computing the exposure at default by using the contractual cash flows data. So we will be performing a present value of those contractual cash flows to the to today and arrive at exposure at default. However, when it comes to funded revolving credit facilities and various other non-funded exposures like LC, BG, etc., that is letter of credit, bank guarantee, how we will be assessing EAD is nothing but we will be taking into consideration the outstanding amount and assign the credit conversion factor to the undrawn amount. How will we arrive at that credit conversion factor is basically we will be again will have to see the characteristics of the historical data in history in past, how the credit conversion factor has been used. So basically we will analyze the historical data and in past how the undrawn portion have been converted into drawn portion, and we will arrive at the CCF for today. So these are the various modeling approaches that we will be applying for computing ECL. However, these modeling approaches needs to be fitted to the portfolio of the bank. And when we say portfolio of the bank, so bank might have corporate portfolio, retail portfolio, etc. So there are possibilities that the bank might want to go for individual assessment. So since the standard does not say how the ECL to be measured, we can assess the portfolios individually or on a collective basis. When we say individually, so we will be setting a threshold to identify the transactions or the customers who would be assessed individually, and else we will be segmenting the portfolio on a homogeneous characteristics basis. So when we say homogeneous characteristics basis, we can use various criteria such as at counterparty level, that is we can classify the portfolios between corporate, retail, and even in retail we can have further segments at the industry level. That is one possibility. We can do it at entity level, we can do it at industry level, or on the basis of tenor. So again, that depends upon the size and volume of the portfolio. These segmentation can be done, and once the segmentation is done, we will have to decide upon the methodologies that will have to be applied for each and every portfolio. Moving ahead. So once we have decided the PD, LGD as well as the EAD component, next is to decide upon the macroeconomic factors that we will have to apply to each of the transactions. Reason being, we want a forward-looking ECL. So what we have currently here is, we have taken these two statistical reports, one from African Development Bank Statistics and other from Kenya National Bureau of Statistics. The one which you're seeing on the left-hand side is basically the projected macroeconomic outlook given by African Development Bank Statistics in the initial days of 2019. So since the right-hand side graph is only pointing out to Kenya, so here, if you see here, for Kenya's country, it says in 2019, the GDP of Kenya will be close to 5.5%, and in 2020, it would be crossing more than 5.5%. However, in actual, in Jan 19, it was 5.5%. That was matching the projections. However, in Jan 2020, it has this is for the entire year. Okay, so here they are saying 5.5, more than 5.5% for the entire year. However, in the very beginning of 2020, the GDP growth rate is only 4.9%. This is basically due to the pandemic, which is currently which has currently affected the entire economy. So we will have to take these kind of economy outlook also into consideration when we are arriving at the economic factor adjustment. So now let's dwell upon more into other economic factors while arriving at the ECL parameter. The graph which you're seeing here is the comparison of correlation between the GDP and the unemployment rate. You see, the red line is the GDP rate and the blue is the one in unemployment rate. The GDP rate is declining after 2019 and it is close to 1.56%. However, the unemployment rate is increasing as soon as the GDP rate is declining. So we have a negative correlation between these two. So we will also have to draw a correlation between each of the macroeconomic factors as well, because the directions which these each and every economic factor sets will directly affect the weights which I will assign finally for converting the PIT to PIT forward-looking PDs. Also, the next is where we are drawing the correlation between unemployment versus the actual defaults. So here, whenever there is a increase in unemployment, there is increase in default. So this is basically default. So whenever there is increase in unemployment, we are seeing an increase in default, and decrease in unemployment is a decrease in default. So it shows a very positive correlation. So between the macroeconomic factors also correlation to be drawn, and between default and the macroeconomic factors also correlation regressions to be drawn. So we have various statistical methodologies using which the correlation and regression can be performed and arrive at the final weightage. So if we see, the outlook looks like downside for next 1 year. So the provision would automatically be increasing. And so the credit risk should be assessed. So the credit risk should be assessed on that basis. And the staging of the transaction should also be done accordingly, keeping all this in consideration. So next, there is also a very good correlation between internal rating, risk-based pricing, as well as IFRS 9. So first, correlation between internal rating and IFRS 9. So when we are evaluating the significant increase in credit risk, so we can also in quantitative indicators, instead along with PD and various other factors, we can also take into consideration the rating grade. So when there is a downgrade in the rating, or when there is a rating is in top notch, so the significant increase in credit risk differs. So, and if we have internal rating in place, we can also perform a correlation between internal rating and external rating and draw a transition matrix. So when we are assessing the PD, instead of rebuttable presumption of days past due, we can also use rating data for computation of probability of default. And outcome of, as I said, outcome of this internal rating can directly be used as computation of PD. So when we are performing staging, we can have a combination of both rebuttable presumption basis as well as rating basis. So that would give a more accurate staging and accurate ECL computation. And the relation between risk-based pricing and IFRS 9. Let's say if the counterparty or the loan has been advanced to that particular counterparty already. So if we take internal rating as well as IFRS 9 into consideration, what can be done is we can take the PD factor into consideration and price that customer accordingly if there is an existing loan of that particular customer. If there is no existing loan, we can draw a similar characteristics between the customer with the industry or with various other portfolios and price that customer by taking into consideration the probability of default and internal rating. So there are two approaches for considering the expected loss and risk-based pricing computation. One is credit risk-based IRB expected loss, and other is as per the IFRS 9 expected credit loss. So this is the basic correlation between rating, risk-based pricing, and IFRS 9. Moving ahead. So finally, this would be my last slide. So the compliance, what we've seen. So the compliance is what we have seen as part of IFRS 9 are as follows. So first and the foremost thing is to perform classification and measurement. So here we would be considering the business model test as well as the contractual cash flow test. And the next step is to perform the staging. So here, while performing the staging, it can be done either on the basis of rebuttable presumption of days past due or on the basis of internal rating. Next is Sicr assessment, where we take into consideration various quantitative, qualitative, as well as the backstop indicators. Once we are done with all of these, then we enter into computation of parameters of PD, LGD, and EAD. And since IFRS 9 says everything has to be forward-looking, that's where we take into account the macroeconomic variables, and the product of PD, LGD, EAD along with the macroeconomic variable is nothing but our ECL computation. And the ECL can be computed at each obligor as well as the portfolio level. And since care risk solution is as Vishu rightly said, that since we have strong focus on research and innovation, we have a specialized solution to comply with IFRS 9 as well. So which has various sophisticated statistical methodologies in place to comply with IFRS 9 and also to enable various auditor and regulator concurrence. Let me now just take you through the system. Just stop sharing. Give me just 2 minutes. So should I share the PPT again or to,
Yes,
yes,
Visa, yes.
Yeah, over to Kishore.
Yeah.
Thank you so much.
Kishore, let me just quickly introduce you and Vakira, right? CARE Ratings as a group, has worked on various even trainings, right, which are up to date, niche, and towards the recent regulatory guidelines, right? So CARE Ratings, along with CIS Kenya, has brought in some of the key, training plans, right, to the Kenyan market, right? So Mr. Kishore is our one of the chief experts, and Mr. Vachira, who is actually our country manager for CARE Ratings as well as CARE Risk Solutions. Now they will actually, explain more, into this, and then post that we will actually, do a quick Q&A session. Over to you, Kishore.
All right, thank you so much, Vishnu. Okay, like CARE Ratings has one of the subsidiaries, CARE Ratings Mauritius, CARE Ratings Nepal. They also have a subsidiary company called as CARE Advisory Research and Training Limited, which only deals into non-rating businesses as well as the training services. We do a lot of training programs all across the country, and we have a lot of trainers and panel with CARE. To name the few of the prominent training programs which we do, I mean, there are a lot of programs, but the prominent programs are corporate credit risk assessment, cash flow statement, excellence in SME lending, and so forth. You can read on the slide. But what I want to focus mainly today is on the same lines what we have been discussing so far is the training on credit risk pricing. So as you all know, one of the success to growth and profitability of a bank depends on the quality of credit decisions taken by its staff. Hence, credit appraisal and approval process is a skill which one should keep on nurturing. So banks do a credit rating exercise of each proposal, and one of the key building block of credit risk management and rating is also used as a measure in deciding the pricing. So on the same lines, credit rating is the key element in banking, in banks switching over to advanced measurement approach as per Basel norms and accord. So all banks are in the various stages of implementing the advanced measurement approach, and improper rating may lead to undermining the whole process of credit risk management, including capital assessment. So there is of course a need for this training. This calls for a thorough understanding of various aspects of credit rating and robust implementation of credit rating system, which of course care rating risk solutions are helping. So of course the credit risk solutions are providing the model, but of course care training would provide a program, a platform which would give you an understanding of from banker's perspective, of course, mainly from the banker's perspective, on various aspects of credit risk assessment and rating scoring framework, like Ms. Visa was telling about the internal and external rating. So, of course, the credit rating, there are a lot of drivers for credit risk. The program takes the participants through the various credit risk drivers, rating models, framework, and rating-driven decisions relevant to a practical banker. So in the banker's language, rather than touching upon only the academics of the subject, it would give you the hands-on experience. So this is actually a 2-day program on credit risk pricing, but on account of this virtual training platform, we can cover this program in 6 hours, 3 hours each day, so that you don't have to sit on at a stretch, and it can be covered 6 hours, 3 hours, split into 2 days, 3 hours each day. And so who should attend this program? Of course, the bankers, whoever is into the credit portfolio, corporate and retail credit business, group managers, credit analysts, and risk management bankers and staff, internal audit managers. So these are the core target audience who would benefit out of this program. The online program, of course, I would not call it as an online program. I would call it rather a virtual program, because it's as interactive as a in-house or in-person training. So this program aims at highlighting the importance of credit risk assessment and pricing, of course, and this focuses on discussions on need of credit risk assessment and the tools available. So there would be some tools which would showcase the models, of course. So this is one on credit risk pricing. Similarly, we do on trainings on cash flow statement. I would not go into the detail about those because we are in a platform which we are talking about only credit risk pricing. So I would like to propose this training to the banks in Kenya. Thank you, sir.
All right. So we are.
Thanks, Vishu and the team in CareRisk for the presentation. Also, thanks, Kishore. As Kishore has explained, our plan is to now extend the training to institutions here in Kenya. The intention is to be able to provide capacity amongst institutions to train or have skill sets within the institution amongst the staff who deal with either credit risk or even IFRS. Now, as you heard from the presentation, especially from Raju, this is actually a very complex subject. You cannot be able to deal with it within a short forum like this. So the idea is that in partnership with CS Kenya, we will now start conducting formal training sessions. We'll be sharing with you through CS Kenya the proposed dates for the first, starting off with the credit risk pricing. This is a follow-up to the presentation we did I think last month on the system on the risk-based pricing. Now, following that, you can select or you can elect to pick any of the topics we've indicated there. The proposal is we can do either cash flow statements or excellence in SME lending. But as you can see, we have a few training opportunities. So we invite institutions to actually advise us as to which training program may also be relevant to them, even as we plan the training sessions. So first, I want to thank you for your participation. And two, that this is not the end of it. As we promised in the conference, we'll carry on creating the capacity as necessary in our market, especially in these challenging times, both in terms of providing the solution as has been demonstrated to you, but also in terms of skills training through CS Kenya. So thank you very much. Over to you, Vishu and Lemo.
Yep. So now we are open to the questions. You can either, put it in the chat box or unmute it.
So Vishu, there's already one question.
Vishu, shall I stop sharing before we...
No, Vishu, Visa, I'll just tell you, one of the person from Supriyo has stated interest rate risk.
Okay. The question is interest rate risk,
volatility risk, how bank will hedge this risk.
Okay. So hi, Supriyo. So basically, these two also form part of the economic factor. So we can, the bank generally consider this interest rate movement as well as the other rate movements when we are when we are computing the macroeconomic factor adjustment and finally factoring it to the ECL. So the historical as well as the forecasted interest rate can be taken into consideration and finally arrive at it. So again, this would depend from loan to loan. Yeah.
Any other questions? Anybody?
Yeah. Visa, there is one more question.
Yeah. I'm just reading it. So the LGD volatility where you have considered about. So basically in LGD, we are not considering the volatility to be zero. So what we are currently doing here is we are taking LGD is nothing but a loss given default. So basically the loss which have already incurred. So when we are computing the ECL for the current transactions, we will not be able to assess the loss today. So that's why we even while computing LGD, we are doing it at portfolio level. So where we are taking into consideration the past data and comparing it with the recovery data or collateral data. So yes, we are taking into consideration the volatility. We are not saying the volatility will be zero. There will be uncertainty involved. Yes.
Yeah, I think somebody is sharing the screen. We request you to stop sharing the screen because it's not relevant.
Any other question?
Yeah, one question, Visa and Arun, from my side, right? Now, if you look into, most of these major markets, right, where, probably the overall, regulatory framework, it's still building up, right? Then in that sense, right, how do you see that IFRS will play a key role, right, when it comes to, strengthening the overall monitoring of the stress which has been built and all that. And then do you think that in one school of thought, as IFRS necessarily stresses upon the possible defaults and all those kind of things, as a regulatory part, do you think that some of the financial institutes or even some of the markets, right, will try to put it further away when it comes to regulatory compliance? Any thoughts on that?
Yeah, Vishu, so here, so actually the evolvement of this IFRS global standard came up only after the financial crisis, 2008 financial crisis. So the main objective of this standard is to have one standard across the entire world. So there is no discrepancies when we are measuring the financial statements. There is no discrepancies in assessing the portfolio. So if the same company, the parent company is in US and the subsidiaries are in India and Africa, etc. So each of their accounting standards and concept differs. So to remove those discrepancies, only the International Accounting Standards Board has come up with this standard. So absolutely, the final achievement would be towards the regulatory framework. I mean, a single regulatory framework across the entire world. So already there are so many countries have already started complying with IFRS 9. So once everyone are in line with IFRS 9, yes, it would be fully complied, and the transparency of the financial statement would be really high.
Thank you.
India ready for IFRS 9? From India ready for IFRS 9, currently I don't think so. Reason being, the RBI is deferring, actually it is not IFRS 9 in India. We are not directly adopting it. We are converging, we are having a convergent standard, what do we call it as Indian accounting standards. Already so many banks have already started preparing, providing for their loans and advances as per Ind AS. But however, they are not disclosing it in their financial statement. Reason being, RBI has deferred it. And the reason being why RBI has deferred it, mainly from the capital requirement point of view. So due to loads of NPAs, so once they disclose their provisions or the final financial statements as per IFRS 9, RBI will finally will have to provide for, they finally all the banks are going to come to RBI for more capital infusion. So that is why RBI is deferring it.
Any other questions, anybody?
There's one more.
How avoid will manage hedge cost?
Visa, read the question also so that everybody can hear it.
Okay. So now Supriya has asked how can we avoid how we will manage the hedge cost, PNL versus OCI. Any thought bank will defer the hedge cost and park under OCI? So actually the thing here is we have not covered the hedge management as part of our webinar today, because that's a different topic and it's a different ocean altogether. Maybe we can connect separately on this. You can drop us regarding this question.
Any other questions? So thanks Visa, thanks Arun, and thanks everybody from the CIS team who have made this possible. And we have continued that. Last month we had the credit rating and risk-based pricing demo, and we have followed up with the IFRS and connected both the how together the whole thing can be done. And we also showed you the glimpse of the solution as well, we can connect the dots between both the from a say credit rating perspective as well from the IFRS perspective. So from Care Risk, we want to thank everybody for coming in and ensuring that you attend the sessions and could and also ask relevant questions for the same. Thank you, everybody. And over to you, Jared.
Thanks, Subu. Before Jared speaks, I think I would also want to make a few remarks. So thank you very much, Vishu, Visa, and Arun, and also Kishore on highlighting on the training areas. So what I would actually want to say at this point in time is that Care Risk Solutions offer a solution that is best in class compared to other solution providers globally. And they bring quite a wealth of experience in terms of implementation on solutions that is in regard to operations and reporting solutions. So in the next 1 month, we'll be having a training on credit ratings that is both internal and external. And we'll also be sharing with you a link to the same. So would actually highly recommend for you to at least sponsor one or two persons in your team so that they're able to go through the training and benchmark with what you've currently implemented. And you can also have a feel of their solutions that you could actually also implement on your end. So we are going to share the slides and the video after this session. So we will send them, we'll send you a link to your email addresses where you'll be able to download the presentation, and also you'll be able to view the video. So thank you very much. And at this point in time, I would want to hand it over to Jared to give his closing remarks. Over to you, Jared.
Thank you very much, Lemuel, and indeed everyone who has participated in this discussion. Thank you for attending, because attendance is part of the success, and for the questions as well. We are open to engaging further with the participants and linking you to the experts in this area. So should you for support from Care Risk in any way, as well as from our CIS Kenya, we'll be very glad to support any of that conversation. Thank you, everyone, and do have a good rest of the day and rest of the week. Bye-bye, and see you in the next session. Thank you.
Thank you, Mr. Jared.
Thanks, Jared.
Thank you.
Thanks.
Thank you.